an introduction to finance for your gap year. I'm not sure if everyone is here yet or they're still trickling in from the other stage, but I think I'll get started just to make sure that we can end on time. But thank you so much for attending my session. Just to give a brief introduction, I think financial literacy is extremely important, regardless of what you want to do in life. I think it's a foundational skill and element that, in my opinion, is not necessarily viewed as finance in specific, but it's more about personal independence, about securing that freedom, about being able to do what you want to do when you want to do it. And it's really the foundation of setting up a lifestyle that works for you. And there's an emphasis that I'll be creating throughout this presentation about you. Finance and financial literacy and personal finance in specific is about catering these techniques and financial concepts to your own lifestyle. And I think a gap year is an exceptional opportunity to really leverage your time off to understand this. And as you'll see throughout my presentation, time is really on your side, and it's extremely powerful. The power of compounding, for example. By starting early, you can really set yourself up for success, especially when you develop those fundamental habits that will be so important moving forward. So I'm so excited to see you all here. Of course, throughout the session, feel free to engage with the chat and let me know any questions along the way, and I'll be happy to answer. And so, yeah, just to initially start off, I want to introduce this concept of time value of money. In today's day and age, I'm sure a lot of you know that inflation is very prominent. And what inflation generally is an increase in the average price of goods and services in the economy. And if you think about it, if the average prices of goods, of everything in the economy is increasing and your cash isn't, then you're essentially losing money. Even though you have $100 today, 2 years from now, that $100 is not actually $100. And that's this concept and notion of time value money. And that's why people invest. People invest to essentially beat this time value of money. And so there's a formula, mathematical formula that I've included here, but you don't really need to understand it. It's just intuitively understanding that, for example, in this graph that I'm highlighting here, that over time, say there's a 6% rate of inflation, over time, your money, whether that's $1 here, will really decrease to about $0.8. And that's just a 6% rate of inflation. Obviously, we don't know what inflation is in the future, but in this current state of the economy, it seems like it's quite high. We're seeing numbers like 7%, 8%, things like that. You are losing money in real term because when, for example, you place your money in a bank account, the savings account aren't paying that much dividends. They're not paying that much interest. And so this concept of time value money is really the foundational element to understanding personal finance and its importance. And so this little diagram over here shows that you want to, one, start early. Two, you want to really be able to control your spending and split your earnings into investments as well as a way to cover your expenses. And I think that takes a lot of planning, especially when you're young. It does get a bit scary, especially it was for me, because I'm not making that much money. I'm really not. And so how do you really get started on this? And I think what's important is the habits, developing those skills, understanding financial markets, because you are setting yourself up for future success. As you can see, the power of compounding. When you invest slowly but surely over time, you gain interest on your interest. And I'll get into that a little bit later, but that can really help you take off with your financial investments. And so I wanted to start with a personal story to really get started. So during my gap year, finance and financial investing and personal finance was an extremely important part of it for me. I really wanted to develop my financial literacy. I wanted to invest more. I wanted to learn about the markets. And this diagram over here shows kind of that concept of emotions and how it can really get you mixed up and doing the exact opposite thing from what is perceived to be rational. And it seems pretty obvious. When the market's at its high, you feel euphoria, you want to invest more. And when the market is down, you feel bad, you feel panic, you feel desperation, you feel fear, and then you sell. And when it's high, you buy. And that's very counterintuitive. That's actually not so rational. But as obvious as this seems, it's hard to implement. For example, when I saw this diagram before, when I was studying about finance, I was like, yeah, obviously. But when I actually did it on a day-to-day basis, I found myself making that exact same mistakes. And this was through cryptocurrencies. So initially, when investing in cryptos, I made a lot of money. I was able to really develop my financial literacy and have substantial gains. It's not necessarily in terms of the dollars amount, but in terms of percentages, because that's what you want to look at, right? You want to look at relative to the percentage, how much gains are you making? And so I was making money. And so I started to take on riskier and riskier bets. When the market started to go up, I got happier. I'm like, I'm going to make more money. It's never going to end. And when everyone is in that state of euphoria, that's when the loss of money comes. And that's what happened to me. I started investing in futures markets, which is more complex financial instruments that are very risky. And so I started leveraging, which is essentially, if I had $10, I would multiply that by 10 to $100. But then every time the market goes up by 1%, it actually goes up for 10%. But every time it goes down by 1%, it goes down by 10%. So as you can imagine, if the market goes down by 10%, you lose all your money. And so that was a very shocking story for me. I lost a substantial amount of money, and it was a very important learning lesson. So that's kind of my story to you. I think it's important to really develop those skills and take that time to learn and understand risk management, because it's very easy to get excited in this whole field. And so one thing I'd have to say is that diversification is key. So what is diversification? It's essentially not putting all of your eggs in one basket, right? So as you can see in the diagram here, it's a way to minimize risk by spreading out your investments. For example, for stocks and bonds and cash and cryptocurrencies, and really creating this portfolio of different investments. That way, for example, if real estate fails or if cryptocurrency fails, but stocks go up and bonds go up, you're balancing yourself out, and overall, you're creating a more safe combination of assets that you hold, which will allow you to be more successful in the long term. And remember, investment, as much as we want to see money now, it's essentially about the long term. It's about creating those habits that will set yourself up for future success. And again, I want to reiterate, as if I didn't at the beginning of the presentation, that this is not financial advice, and I just want to share some of my own personal learnings. But take out of it what you will, and do your due diligence, do your research, try to understand these concepts, because I think they're really important moving forward. And so one thing I want to talk about in diversification is something that we learned, that you will learn in an introduction to finance class within university. There's this concept about unsystematic risk and systematic risk. And so what's systematic risk is risk that occurs throughout the entire economy. For example, inflation, that affects everyone and everything. World wars, events that really impact all of the markets. Those are things that honestly you cannot control. But what you can control is unsystematic risk. And what unsystematic risk is risk that is specific to the stock or the instrument you buy. For example, you buy Tesla and Elon Musk tweets something that really affects the share prices. That's unsystematic risk. And that risk you can actually mitigate by diversifying. So by investing in more assets, by doing this diversification between stocks and bonds and cash and things like that, you can really mitigate that level of risk. And that's what it shows here. You can really decrease your risk all the way to this line of systematic risk, if that makes any sense. And of course, feel free to message me or add to the chat with any questions that you have. And so what does this diversification really look like? And that's up to you. It's up to you. What is your risk tolerance? These are questions to ask yourself. Usually when people are younger, they're more willing to take risks because they have time on their side. But it depends on your specific situation. Do you have financial support? Do you have emergency funds in case things go bad? Do you have the money to support yourself to take those higher risks? Would you need to, say, in the next 1 or 2 years, take out your money for personal expenditures, or will you not? All those questions you'll need to ask yourself to determine how much risk can you take on. And now, speaking of risk, there's this pyramid that shows this entire level of risk. And it starts from, cash within your checking account, your saving accounts, and that's in your bank accounts. They're saving bonds and things like that. So these are all saving tools, essentially opportunities for you to save your money. And there's no volatility except for the fact of inflation. So the money, while it does seem stable, you may actually be losing money in real terms because of inflation. And then we kind of move up that pyramid to bonds and mutual funds and index funds and stocks and real estate. And then things start to get more risky. And I'll go into specifics of some of the important prominent financial assets, but I'd recommend you to really take the time to, look through these assets. What are they? What do they represent? How are they valued? What are they created from? These are questions to start asking yourself. And I really want this introduction to be an opportunity to kind of gauge your excitement and look into these things. Because, for example, real estate, that seems really scary. Like, how am I going to buy a house at 17 years old? But there's something called real estate investment trust. And what that means is you can put in, say, $100 or even $50 into a pool of money that another company is using to buy a bunch of houses and properties and things like that. So you are actually investing in real estate with $50, and that's possible. So there's so much out there that you may not understand. And that's why I recommend you to just get started and go Google things and go to YouTube things and things along that line. But as a brief overview, and I don't have much time, so I apologize if this is a bit rushed, but index funds are pretty much investment funds that are based on this preset basket of stocks or indices. And so what that means, for example, is say the S&P 500, and I'm not sure if you've heard of this, but the S&P 500 represents the top 500 companies within the US stock market. That's an example of an index fund. So by putting money in one index fund, say you put $100 in one index fund, you are automatically diversifying that money across the top 500 companies within the US. And that's just one example. There's so many types of index funds, whether it's like biotechnology or technology stocks or industrial stocks or oil stocks, or like emerging market stocks or stocks within Asia or bonds within Asia. There's so many types of index funds that are preset based on a basket of stocks, or otherwise. And there's also something called mutual funds. And there's two types of mutual funds. There's one that's actively managed, which means that there is a professional sitting there and actually selecting what stocks to buy, selecting what bonds to buy. And you just putting in your money, and other investors are pulling in their money. And now this professional has the resources to kind of invest in different things. And you will see those returns. But obviously, that comes at a fee. There's also the type of mutual funds that aren't actively managed. And that means there's probably a lower fee. And the way that works is, again, as I explained earlier, similar to index funds, it's preset. They set these criteria from the outset. And then you're constantly investing in that whole bundle of goods, whether it's, for example, stocks within Vietnam and Cambodia and Laos. Then there's exchange traded funds, and these operate very similar to the two aforementioned ones, but you're able to trade them on stock exchanges. They kind of appear as if it's one stock, and that's a bit confusing, and there's a lot of intricacies to it. So I suggest, if you're interested, to go search or message me to get more information about that. There's also bonds. And so what bonds are they essentially, and this is quoted from Investopedia, that an issuer owes the holder a debt and is obliged, depending on the terms, to repay the principal of the bond at the maturity date. So in simple terms, say the government wants to borrow money. They need money to build a highway. And so they issue this bond to get $1 billion from a bunch of citizens across their population. And in return for the money of the citizens, the government will have to pay increments of interest back. So just like if I were to go to the bank and borrow money from the bank, this is large corporations or governments issuing bonds to really get those large financial investments, and that's a debt instrument. Also stocks. I know a lot of you have heard of stocks, and that's essentially shares of corporations or company, which really represents how ownership is divided. So by owning a share, you're really actually a very small fraction owner of a company. You can be an owner of Apple. I'm an owner of Apple, and I've barely put in any money into it. So things like that, it's really cool to really get into that concept. And by investing in these stocks, you're automatically more cognizant of the news, of different companies and things like that. So if that's what you're interested in, that'll be great. A great opportunity to really get you intrigued into that thing. And then finally, there's cryptocurrencies, and that's really popular in this day and age. And it's essentially, in the broad scheme of things, and this is a generalization, it's a digital currency, which is an alternative form of payment, which is created using encrypted algorithms. But it's important to note that that's not just cryptocurrencies. And that's Bitcoin, for example, but there's a bunch of other cryptocurrencies. And honestly, they are quite hard to understand because they don't have fundamental value. They don't have profits coming in. But some of the technology is very promising. And so you really have to dig deep. And I recommend you to do your due diligence every time looking into cryptocurrencies to see, what exactly is this? What is the potential for this? Where can it go in 10 years? And it's hard to really break that down. So YouTube is your best friend. Google is your best friend. And try to kind of consult a variety of sources because there's a lot of misinformation out there. And I would say particularly for cryptocurrencies. So again, very high risk asset. I have a question here. Where do you think cryptocurrencies fall? And in my opinion, that'll be very much on the top of this pyramid. And so since it's so risky, in my opinion, I would allocate a smaller amount of money to cryptocurrencies. Just because of that risk. But again, high risk, high reward. But if you put all your money in cryptocurrencies, like I said in my personal story, you could lose the majority of your money. And trust me, that's not fun. And even when you think you really aren't, and you're so confident you aren't, putting in, say, 80%, 70%, 60% of your investments into cryptos or one asset at all, in my opinion, is not necessarily the best idea. And so one technique that I would employ, and one technique that I do employ, is this concept of dollar cost averaging. And what dollar cost averaging is it's essentially investing in equal amounts of money at regular intervals. So for example, I would say every Wednesday, no matter what the price is, I'm going to put in $100 into a broad array of different stocks and bonds and ETFs and cryptocurrencies according to that portfolio that I talked about earlier. And I don't care about the price. I'm not analyzing anything. I'm not reading the news. Every Wednesday, no matter what, I'm putting that in. Why would I do that? Why would somebody do that? And so the benefit of this is that you're actually reducing risk and you're maximizing your long-term returns. What you want to do is you want to stick to your plan. You want to set something up, and it honestly doesn't necessarily matter what you set up. It's just that to ensure that it's systematic. And this could be tied to your income. For example, if you're getting paid, maybe 20% of your salary goes into that diverse portfolio of stocks every month or every 2 weeks or things like that. I mean, you're really splitting that up and creating that system and that habit. And so what you're doing here is you're essentially reducing market volatility. As you can see, maybe on this Wednesday, the price is here, but on this Wednesday, it's up. Maybe on this Wednesday, it's all the way down, but on this Wednesday, it's all the way up. And in constantly doing that, regardless of the price, you're reducing market volatility and you're averaging into the market at a good price. Because we believe, and I believe, that no matter what, within the long term, 10, 20, 30 years, the world's going to develop. Stocks are going to go up, bonds are going to go up, financial assets are going to grow, inflation is going to hit, things like that, and that these things will grow. And so it doesn't matter on the day-to-day basis where the prices are. You don't need to really meticulously look into that. Rather, you're putting in money regardless. And this is one of the ideas that you can employ or not. It's just an idea and it's a strategy that I personally find useful, but you may not. And again, I'd ask you to reflect about how does this fit into your daily habits? How does it fit into your income, the money you have available, things like that. There's a lot of things that must go into that as a consideration. But again, as I mentioned earlier, there's this very important power of compounding. And what compounding is, it's essentially you're earning interest on both the money you've saved as well as the interest you earned. And if that makes sense, I'm trying to imply that, for example, I put in $100 into my bank account, or I put in $100 into a stock, and that stock gives me a 7% return. And so at the end of the year, I have a 7% return on that $100. But now in the next year, not only am I making, say the stock returns another 5%, not only am I making a 5% return on that $100, but I'm also making a 5% return on that $100 plus the 7%. So as you can see over time, and this is really not intuitive, there are studies that show that this is not intuitive for the human brain, but over time, you can really significantly develop your earnings just because of the power of compounding. And that's why I think it's so important, so important to start early. Even though you don't have a lot of money, even though it's small, maybe it's $5 a week, whatever it is, start early because you're developing that habit and you're allowing compounding to kick in. For example, there's this research paper on Warren Buffett. I don't know the specifics of it, but it kind of analyzed that if he were to start 10 years later, there would be a substantial, very significant drop in the amount of money that he would have today. He may not even be amongst the very top richest people in the world just because of how early he started. He's able to achieve that. And so if that doesn't emphasize the power of compounding, I recommend you to, look more into this and watch YouTube videos and things like that. And I hope that will emphasize it for you. Okay, so there's two types of analysis that you can take within all of these financial instruments. One, it's called fundamental analysis. And that's really about understanding patterns in companies' financial performance. You're looking at their balance sheet. You're looking at the profits that are coming in. You're looking at the actual company. What's in the news? What is the CEO doing? What is their strategy? What is happening? And you're looking at that for long-term investment. You're really analyzing what there is to benefit from that company in the future. Whereas technical analysis is looking at patterns. And so people usually do this in the short term. They're usually trying to understand patterns in company share prices, trying to understand historical patterns and share prices that would repeat in the future. And it's important to note that these technical analysis aren't tied to the financial asset itself. You're not looking at, is this bond valuable? Is the government reputable? You're not looking at, is this stock producing profit? Is the company doing well? Is the management of the team good? Within cryptocurrencies, and this is very popular within cryptocurrencies, you're not looking at the technology behind the cryptocurrency. You're not looking at what is that in cryptocurrencies. Rather, you're looking at patterns. And this is something that you can consider whether it's beneficial. But in my opinion, and there's a lot of research papers that show this, that technical analysis is not necessarily a sustainable way to make money. Firstly, it's very short-term oriented. And sometimes these patterns don't hold true. Sometimes it will, but sometimes it doesn't. And so it's very hard to master, and a few people make money from it. And a lot of research has pointed that there is no real benefit in technical analysis, and that the most effective way to go about it is to invest and do this fundamental analysis and invest in the long term And that has proven to have a lot higher returns for people. But of course, not financial advice. I'm just trying to present different sides of the spectrum, and I'd encourage you to conduct that analysis within yourself and evaluate what might be a better medium to conduct your analysis. But for example, if you want to explore technical analysis, if you want to look at patterns, and you want to test that out, go ahead. Maybe try that with a simulator. Maybe just test that out for yourself with smaller amounts of money and things like that. It might be beneficial and a good learning lesson regardless. Okay, so now I want to kind of conclude with some ideas to get started. Firstly, I think it's really important to have a fundamental understanding of financial markets. And this is something that you can expect in university level introductory finance classes, but it's something that I find is even more effective when you learn it by yourself through YouTube, through reading the news, through a variety of courses such as Coursera, Skillshare, LinkedIn Learning, Udemy, EDX. There's so many opportunities out there to really develop your knowledge. And to me, to be honest, YouTube was the best. I got to learn about the real world. YouTubers such as Graham Stephan was exceptional in that, or Andre Jick. And so there's so many YouTubers out there, and feel free to message me if you want more recommendations regarding that. But I recommend you just get started, try to learn, have this authentic learning lesson. Like, I want to figure out technical analysis. Based on this presentation, you found a few things that you're interested in, YouTube it, Google it, try to figure out how to get started with that. How do you open a brokerage? How do you select a brokerage? All these things are very much a process, and you will learn authentically every step of the process by just trying to figure out yourself. Try to figure out where to start, try to figure out where to go, try to figure out what analysis you can conduct and how to conduct that analysis. And in the process, you will really learn and develop your skills. I think time is on your side, especially with your gap year, and it's a great opportunity to get started. And so, while to be honest, you don't really need an understanding of financial markets and these complex terms to be able to invest, but I think it's a very important foundation. Understanding how stocks and bonds are valued. What is NPV, net present value? What is risk? How do you measure risk? How do you prevent risk? How do you mitigate risk? What is inflation? What are interest rates? What are the bond features? What are options and futures if you want to get into the more advanced financial instruments? Understanding the characteristics of each financial asset specifically and in detail, such as what are bonds, stocks, cryptos, index funds, mutual risks, what are their respective risks that are associated with, and things like that. And really understanding the banking system and market efficiency. So again, these aren't necessarily required, but I think it provides a great foundation for you to really understand the market at large. And now when you're making these decisions and when you're developing the skills, you understand that in the context of a financial market. And by understanding the financial market, in my opinion, I think you're a lot less prone to making more mistakes, like I clearly did in the story that I told earlier. And so one thing that I recommend is test different strategies you've learned. You don't necessarily need to put your money in the line. Use a stock simulator. Find what strategies work for you. I read this book called The Psychology of Money, and it really emphasized this important theme throughout, that you need to invest for you. What is your lifestyle? What do you want in the future? Are you okay waking up in the morning with a lot of volatility, but knowing that you're taking a lot of risk, so you may get rewarded in the future? Or do you want steady, slow growth that may not give you substantial returns, but you're willing to wait it out and let the power of compounding kick in? There's no right answer. It's about your lifestyle. It's about what works for you. And that's something that you can figure out over time, as well as the strategies that work for you. And so that's something that I figured out over time. And I'll get to my strategy a bit later as well with the dollar cost averaging supplement. But learn and try out what works for you. For me, a simulator honestly didn't work because I was lazy. I didn't want to look at it. I didn't care. But when I started putting my money on the line, my hard-earned money, then I started to care. Then I started to really dig deep into, where am I putting my money? Where's the financial investments? Following the news. And even though it was a very small portion of money, it got me intrigued. It got me looking at, even though it was barely any money being made or lots, I looked at the percentages, and I encourage you to look at the percentages. When you're starting small, when you're starting with small investments, look at the percentages, and you'll be able to see what returns you're actually getting, right? So if you multiply that percentage by, say, $100,000, if you were to invest $100,000 and you had that money in the future, this is the returns that you're actually getting, and it's important to understand that. But don't be greedy. Understand that emotions can take over, and try to develop a system that works for you, and test and try and try to manage your risk, because I think that's a really important thing. You don't want to be putting your money on the line, especially at such a young age. It is hard-earned money, and things like that. So it's important to really do your due diligence to make sure that you're learning, but not taking too much risk. And so now I'm going to talk about really getting started, the nitty and gritty. And so there's one thing in Canada that is really, really beneficial. And I'm not sure if you heard of this, but there's something called the tax-free savings account. And so what that is, it's essentially an investment account that allows all of us to invest without being taxed. And that's actually a really good program. It's not common for governments to do that, and it's a great opportunity to really take advantage and leverage from a young age as a student within Canada. And so you automatically get a tax-free savings account at 18 years old. And I'm an international student, and I have a tax-free savings account as well. And so the way it works is that each year you're given a contribution limit, and so you're giving $6,000 in recent years. So as you can see in this table over here, and you want to make sure that you do not exceed that contribution limit. And there's no worries if you cannot reach that contribution limit. Add how much ever you want. But up until those $6,000 each year, you are not getting taxed. And those are cumulative. So they add up totals. So say you're 18. When you turn 25, that $6,000 each year will add up. So even though you're not investing when you're 18, 19, 20, or 21 up to $6,000, you will have that contribution room in future years. And so that tax-free savings account is really there. And it's a government program to really incentivize people to invest and develop this financial literacy. And so I think it's really important to invest with your TFSA. And one thing that some people would recommend, and of course do your due diligence and research before kind of concluding on this, is that you should be conservative with your tax-free savings account. Perhaps index funds, as I talked about earlier, to really prevent your losses from being too hard because it's not tax deductible. And this is really getting to the nitty and gritty of things. But for example, if you were to make significant losses in a non-tax-free savings account, then you can outset your gains from those losses tax-wise. And I know that sounds a bit complicated and you don't need to know it at all for now, but I'm just trying to give an insight into what that means. In your tax-free savings account, since nothing is taxed anyways, your losses aren't going to be tax deductible. So perhaps it may make sense to be more safe with your money and things along that line. And when you really are ready to invest, it's about finding a broker. And this is not brokers that are specifically in Toronto. Perhaps it's except for TD Ameritrade and Interactive Brokers. There's a lot of other options. For example, I use Wealthsimple. I wouldn't necessarily recommend one for all, but rather I want to give you an overview of the different things to look for. You want to be looking for the minimum fees to trade. You want to be looking for the commissions and how that works. You want to be looking at what is the currency exchange fees? For example, that's not something people usually consider. If you're buying US stocks in Canada, there's a currency exchange fee. What is that fee? How much does it take away from your returns? You really need to investigate sophisticatedly into all the fees and all the fine print of your brokerages, because although it may not make as substantial of a difference when you're just getting started, if you're going to stick with that brokerage over time, those fees and those commissions accumulate. And so you really want to find, again, this is about you and what works for you. How much do you want to trade? If you're planning to invest big and have these big trades, but you're going to buy them one at a time, then maybe it makes sense to have one of those more expensive minimum fees and trades, but lower commissions. Or maybe you don't want to invest much and you want that zero minimum fee trade. You don't want commissions. You want a flat, low commission, things like that. You really want to just do that exploration yourself and figure out what works for you. And so I want to give a brief glimpse into what my portfolio looks like, through my learnings across the year. And again, this is not financial advice. By no means should you replicate this because, as I emphasize throughout, it's about you. It's about what works for you. And so I used Wealthsimple for this. And I dollar cost average into my tax-free savings account. And this is kind of the mix of where my money goes. As you can see, there's a big mix here. And I would like to point out that I do also have a small portion of money, I would say no more than 5% within cryptocurrencies in another account. So I also invest in cryptos, but again, as I said, the risk of cryptos from, my learning lesson of putting 60 or 70% of my money or my investments into cryptos and losing it pretty much all, I learned to reevaluate. And I still invest in cryptos because I think that high risk and high reward has potential, but I know that it has high risk. And so I'm not going to put 50% of my money into such a high risk asset when I understand that diversification really limits that risk and allows more long-term sustainable investment growth and will set me up for greater success in the future. And so, again, my combination is 28% within U.S. equities. And so that's a combination of pretty much all the stocks within the U.S. 22.5% within international equities. So that's a combination of different prominent stocks across the world. So not necessarily in Canada or the U.S., but everywhere. Important and prominent EU companies that are doing really well and sophisticated. And again, you can actually search up these specific ETFs that are listed within the slide. Take a screenshot, if you will, and Google them to see what's within each fund, and you'll be able to kind of learn more about that. And and find what works for you. And so again, we have emerging market equities. And so that's emerging markets. So companies that are now developing, like Vietnam or Laos or India, the companies that really have this potential for significant growth, in my opinion, because, in my opinion, a lot of economies such as India are really taking off, right? Yes, exactly. It is not financial advice. That's right. So as I said again, Dogecoin is very risky, and I lost a lot of money myself when I did that. So be smart. Find everything in the context of your risk management, your risk tolerance, and ask yourself what works for yourself. And so I also invest in Canadian equities, and that's 11%. I invest in global equities, and by equities is another term for stocks. So again, stocks, like I explained earlier, these kind of having a percentage ownership of the company, although it's probably very, very tiny, especially for me, because I don't put in that much money, because I don't have that much money. But it's about the habit. Remember, it's about getting started and kind of putting yourself in that situation to dollar cost average and find what skills works for you and what strategy is best for you and for your lifestyle, because by establishing that early on, you're going to benefit from compounding and you're going to learn over time. So also, I put in government bonds, I put in gold, and I put in cash. And if you notice, my percentages of the government bonds, gold, and cash is quite low. For me, in my personal situation, I I would like to take more risk because I'm younger and I have that time to wait, and I'm in a financial position that I am able to take that risk without having to take out my money to really spend on an emergency fund or emergency expense. And so that's why I'm taking on more risk by putting a larger proportion of my money to these equities and stocks and cryptocurrencies, but I'm putting a smaller proportion within government bonds and gold. And my idea is, as I get older, I'm going to start to move that money from the stocks and those gains into bonds, because bonds are less volatile. And again, there's so much more information with these specific financial assets that you can really learn about and develop as you go forward in your journey. But this is just to get you started and to get you intrigued about that. Awesome. And so thank you, Mahak, for your question. If anybody else has any other questions, feel free to ask it below. Um, that's a great question. Honestly, I thought I wanted to get into investment banking, or VC or private equity or any of that, but I don't think I want to do that anymore. So throughout my gap year, I did internships and I kind of explored that role of finance, and I think it's really important. I know its importance within personal finance and developing that financial literacy for myself, but the lifestyle of an investment banker is not one that I want to have. I value, work-life balance and things like that. And I'm really interested in marketing and consulting. So that's kind of the avenue I'm taking. That being said, I'm open to finance. I'm learning about finance. I'm doing those courses within university. But at this moment, I don't necessarily see myself going into any of those, to be honest. Thank you for the question. Feel free to let me know if you have any others. Thank you so much. I really appreciate that. That means a lot. Yes, please feel free to connect and ask me any questions. I'm going to send my LinkedIn profile right now, so all of you can connect. Just maybe mention within the connect request that you saw me within the Gap Year Association webinar, and I'll be more than happy to connect and talk about finance. I'm no expert, obviously. I'm still learning. I'm still trying to figure things out, but in the process, I think we can collectively learn and develop and grow together. Awesome. So any other questions at all about me personally or about the finance, about the presentation, feel free to let me know.